This Week in Economics on the 6th of January 2019. Our first program for the month of January and also for 2019. We've been doing this now about 10 years or so. We're at the 500 mark as far as productions for this macroeconomics program, coming to you from WBRN Radio and on the Bostonred Network. And we are broadcasting from the Jerry Pippin broadcast booth on our server in New York. Been a very interesting week here. We have some the latest as far as the employment figures from the Bureau of Labor Statistics out of the Labor Department, incidentally, because of the government shutdown. The Bureau of Labor Statistics or the statisticians, etc., are not there. This was put out by the Department of Labor, so we'll take these and look at them as they are. We also have some commentary from various other functionaries out here at CNBC, etc., and from the market people, we have PCIs for the U.S. and from some of the emerging nations at Kenya, and let's see, who else do we have here? We have several from the Irish Republic, Uganda, and Kenya, the Stabik Bank there from Germany. These are just some of the PCIs we have. And we have the service PCI for the U.S. and also from China. We have the General Services PCI there. And the manufacturing PCI for the U.S. also. And from Mexico, we have their PCI Comunicado de Pecio, and I'm going to have to get the English translation of it up here. But nonetheless, from CNBC, manufacturing industry posts biggest annual job gain in 20 years is the headline here. So we'll get on with it now. The U.S. this is in December, created 312,000 jobs. The rate of unemployment or redundancies rose a tenth of a point to 3.9. This is really not as relevant. Job gains in healthcare, food services, drinking places, construction, manufacturing, and retail trade. Now, the revision of seasonally adjusted household survey, we always have two of these, seasonally adjusted back to January of 2014, were subject to revision. The unemployment rate for January 2018 and to November were some revisions there. Now, this is the household survey. Now onto the household survey. The unemployment rate rose by 0.2. I thought it was 0.1. Okay. To 3.9 in December, and the number of unemployed persons increased by 276,000 to 6.3 million. A year earlier, the jobless rate was 4.1%, and the number of unemployed persons at that time was 6.6 million people. Amongst major groups, adult men at 3.6, African Americans at 6.6%, increased in December. The rate for adult women at 3.5%, teenagers at 12.5%, for Europeans 3.4%, for the broad group classified as Asian 3.3%, and Latinos or Hispanics at 4.4%. They showed little or no change there. Amongst the unemployed, the number of job leavers, this is something new here, increased by 142,000 in December to 839,000. Job leavers are unemployed people who quit or otherwise voluntarily leave their previous job and immediately begin looking for new employment. In December, the number of long-term unemployed, those jobless for more than half a year, 27 weeks. Was little change at 1.3 million, accounting for 20.5% of the unemployed. Over the year, the number of long-term unemployed was down by 205,000. The labor force participation rate at 63.1, little changed in December. The unemployment population ratio at 60.6 for the third consecutive month. Both measurements were up by 0.4% over the year. The number of part-time, for economic reasons, these are part-time employed, referred to as involuntary part-time workers, at 4.7 million, a little change there, but was down 329,000 over the year of 2018. Individuals who would have preferred full-time but could not find it. In December, 1.6 million persons were marginally attached, little change from a year earlier. These individuals are not in the workforce, wanted and were available for work, and had looked for jobs sometimes in the 12 months prior period. Among the marginally attached, 375,000 discouraged workers in December. This is a fairly large number, down by 99,000 over a year earlier. That would have been, 2017. The remaining 1.2 million persons marginally attached to the labor force had not searched for work. Now on to the establishment survey. We have two of those. The total employment increased by 312,000. They still call it non-farm. That's a carryover from the 40s and wherever else. Payroll employment rose by 2.6 million in 2018, compared with 2.2 million in 2007. Now we get to the major categories here. Healthcare rose by 50,000. And this was a segment that many of the conservatives claimed, or they all claimed, basically, that the Affordable Care Act, Obamacare, would totally destroy. It has not happened. Job gains occurred in ambulatory health care services, 38,000 there. Medical centers at 7,000. Healthcare added 346,000 jobs in 2008, more than the gain of 284,000 jobs in 2007. Employment in food and drinking places increased by 41,000. Over the year, that particular industry added 235,000 jobs. Similarly, increased the increase in 2017 of 261,000. Construction rose by 38,000. A mild winter, evidently, for that. Job gains in heavy and civil construction, 16,000. Non-residential specialty trade construction by 16,000. Construction industry added 280,000 jobs in 2008, compared with 250,000 in 2007. This was 30,000 there. Manufacturing added 32,000 jobs in December. Most gains occurred in durable goods, 19,000 there, with job growth in fabricated metal products, 7,000 there in computers and electronic products, 4,000 there employment in non-durable goods. Components increased over the month at 13,000. Manufacturing employment increased by 284,000 over the year, with about 3/4 of the gain in durable goods industry. Manufacturing added 207,000 in 2017, almost 80,000 more, not quite that. Retail rose by this retail trade by 24,000. Growth occurred in general merchandise in 15,000. Auto dealerships, just 6,000. These gains were partially offset by job losses in sporting goods, hobbies, banks. Music stores are down by 9,000. Retail trade employment increased by 92,000 in 2018. Little change from a negative little net change in 2007. A negative 29,000. Over the month, employment in professional business services continued to trend up, 43,000 there. It added more than manufacturing at 583,000 in 2018, outpacing the 458,000 in 2007. Employment in other major industries, mining, wholesale trade, transportation, warehousing, and government showed little change there. The average work week for full-time workers increased by 1/10 hour to 34.5 in December. In manufacturing, both work weeks and overtime increased by the same thing, 1/10 to 40.9 hours and 3.6 respectively. The average work week for production and non-supervisory workers held at 33.7. In December, the average hourly earnings for all workers rose by 11 cents to $27.48. Over the year, the average earnings increased by 84 cents or 3.2%. The average hourly earning of private sector production workers increased by 9 cents to $23.05. The change in employment from November was revised up from 155,000 to 179,000. The change for October was revised up from 237,000 to 274,000. With these revisions, November and October combined 58,000 more jobs than were previously reported. This time of year, we have that revised jobs gains averaged 254,000 over the last 3 months. We'll get another report on January's on October the 1st, effective with the release of the employment situation in 2019 on February the 1st. New population controls will be used in the household survey estimation process. The new controls reflect the updating of intercentral central population estimates by the Bureau of U.S. Census Bureau in accordance with the usual process. Historic data will not be revised to incorporate the new controls. On January 2019, will not be directly compatible with data from December of 2019. Now, the revision in the establishment survey that's also released this month, and it'll be released on the 1st of January. The establishment survey will introduce revisions to what they call non-farm employment hours, earnings, and data, and reflecting the annual benchmark process and update dated seasonally adjusted factors, not seasonally adjusted data beginning with April of 2007. The revision of seasonally adjusted household survey for each calendar year of the Bureau of Labor Statistics routinely updates the seasonally adjusted factors, and we won't get into some of this. We will append this so you'll be able to look at it, the season-adjusted employment rate for 2008. If we look at it as first published back in January, it was 4.1%. In February, 4.1%. We won't do all of this, and it fell to 3.9% in August and 3.7% in November. And the revision is basically about the same, and we won't get into the rest of this. Now we'll go to the manufacturing report. Now this is from the Institute for Supply Management. This was on January the 3rd, 2019. Their PMI at 54.1. New orders, and these are in Tempe, Arizona. Economic activity in the manufacturing sector expanded in December, and the overall economy grew for the 116th consecutive month, says the nation's supply executives in the latest manufacturing ISM report. The report issued today by Timothy Ferre. He's chair of the Institute for Supply Management's Business Survey Committee. The December PMI registered 54.1. a decrease of 5.2% from a November reading of 59.3. The new orders index registered 51.1, a decrease of 11% from a November reading of 62.1. The production index registered 54.3, that's a 6.3 percentage point decreased from the 60.6 in November. The employment index registered 56.2, a decrease of 2.2 from a November's reading. The supply delivery index, they have a lot of indexes here, incidentally, at 57.5%, a 5% decrease from a November reading of 62.5. Investor registered 51.2%, a decrease of 1.7% from November. The price index registered 54.9%, a 5.8% decrease from November, reading of 60.7, indicating higher raw material prices for the 64th month. Comments from the panel reflect continual business expanding business strength, but is at a much lower level. Demand softened with new order index retreating to recent low levels. The consumer inventory index retreating too low. A positive heading into the into the first quarter of 2019. The back order index declined to a zero expansion level. Consumption continued to strengthen, with production employment still expanding, but at a much slower pace. And this has been the pace of these PCIs for several months now. Exports are continuing to expand, but at a lower level, consistent with November. Price increases relaxed to the levels not seen since June of 2017. When the index registered at 53%, the manufacturing community continues to expand, but at a much lower level. Of the 18 manufacturing industries, 11 reported growth in December in the following order: textile mills, apparel, leather and applied products, machinery, transportation equipment, computers and electronic products, wood products, chemical products, food and beverage and tobacco products, miscellaneous manufacturing, electrical equipment, appliances, and components. 6 industry reported contractions in their order: printing and related support activities, fabricated metal products, non-metallic mineral products, petroleum and coal products, paper products, and plastic and rubber. So now we go to the market series. The U.S. service PMI new business growth weakened since October of 2017. Let me just get this up a little bit here. The U.S. service sector signaled a solid expansion in business activity in December, the slowest for 3 months. The rate of growth in new business eased to a 14-month low. The pace of job creation picked up. Subsequently, panelists registered a renewal fall in backlog as pressure on capacity decreased. Concerns surrounding the longevity of the upturn in new business led to the weakest expected rise in output since December of 2017. Moreover, input prices rose at the slowest pace since August, in line with a soft rise in a cost burden, less robust client demand, the weakest pace since 2017. The market U.S. service index registered 54.4, over 50% means that things are moving along, down from 54.7 temps in November, but up from the early reported flash figure of 53.6. The rate of new business growth eased for the third consecutive month in December. So we're beginning to see a pattern here of this happening in line with the weakest rise in new business. Service providers registered a low degree of optimism towards future business activity in December. Subsequently, firms raised their selling prices in an effort to partially offset higher input costs. So the comment here from Dr. Williamson, service sector business activity grew at a reassuringly solid rate in December, although like manufacturing economy has seen the pace of expansion moderate somewhat since the strong rates enjoyed in early in the year. Despite the slowing of the December survey remained constant with GNP growth at a healthy annualized rate of 3.5% in Q4, with momentum easing only slightly on the quarter. Hiring also remained encouragingly buoyant. The December survey is indicative of non-farm payroll growth of approximately 190,000 jobs, mainly driven by increase in the service sector. Growth may continue to moderate in the coming months, however, as backlog of unfinished work across manufacturing service sector failed to rise for the first time since 2017. Inflationary forces. Now, this is one of the things that the Fed has alleviated by raising the interest rate. Forces, meanwhile, cooled during the month as lower oil prices, petroleum prices helped to evade upward cost pressure from tariffs and to a lesser extent wage growth. Wage growth is not that much. Some feel, though, to lower consumer inflation in the coming months, the PCI inflation dropping below 2%. Let me just move along here. Go back to the U.S. and then we'll come back here. I believe we have the manufacturing PMI. This is the U.S. We'll just go over it. Anyway, the new orders eased to a 15-month low. Business confidence lowest since October 2016. Production growth remained solid in December, and this is market's version, at a rate matched that seen in November. The rise in input was attributed to a greater new order volume. That said, the upturn was nonetheless the joint weakest in 14 months. Let's get to what Dr. Williams has to say here. Manufacturing reported a weaker pace of expansion at the end of 2018, and has grown less upbeat about prospects for 2019. This is pretty much a universal growth, a universal prediction here. Output and order growth grew at the slowest rate for over a year, and optimism about the outlook slumped to its gloomiest for 2 years. He used the word gloomiest. The month around of Q4, in which manufacturing production is indicated to have risen at only a modest annualized rate of about 1% here. Some of the weaknesses due to capacity constraints, with producers again reporting widespread difficulty in finding a suitable staff. Now, that is one of the very big problems in the U.S. Just over two-thirds of manufacturing reported higher costs contributed to the rise in prices to tariffs. Growth was led by strengthening demand for consumer goods, and robust growth was also reported for investment goods such as plant and machinery. But producers of intermediate goods who supply input to other manufacturers reported the weakest rise in new orders over 2 years. A shift to inventory reduction was highlighted by purchasing activity in the manufacturing sector, rising at the weakest rate for 1.5 years in December, providing evidence that companies have become increasingly cautious about spending and rising uncertain capacity about the outlook. This is something that has been brought out here. Let me just go to the CNBC. I believe manufacturing industry posts biggest annual job gain in 20 years. This is since 1997. That was a dot-com boom. Manufacturing posted net job gain of 280,000 over the year of 2018, as we reported. Manufacturers are bringing people back into the workforce. We need this trend to continue. That's from Dr. Chad Monterey. He's the chief economist at the National Association of Manufacturers, whose industry faces a workforce crisis with more than 500,000. This is where also what Dr. Davidson was talking about there. A workforce crisis with more than 500,000 open jobs and 2.4 million jobs expected to go unfilled the next decade. In other words, 10 years. Closing the skill gap continues to be a challenge. Healthcare and education saw the greatest month-over-month net change in job growth in December, adding to a year of mammoth job creation. Healthcare alone accounted for 50,000 new jobs in December, while construction and manufacturing had healthy gains, but not at the gains. The CNBC studied the net changes by industry for December. The jobs based on data from the Department of Labor contained in the jobs report. We went over that. The economy, of course, added to 312,000 jobs, more than 177 estimated for the increased polled by some. The Reuters. All of the polling agency had the job increase for December at below 200,000. Healthcare and education combined for outpatient social assistance to teachers, professors, a net gain of 82,000 jobs. Home healthcare services, 13,300. Physician offices, 6,700. Inventory, we gave that one before, accounted for 37,000 new positions, while social assistance services, 7,000. Education, 24,000. Their job gains occurred in healthcare, food services, etc. Construction added 38,000. That's because of seasonally stronger weather conditions. But that is about to change. Leisure and hospitality gained 42,000 jobs. Now let's go back to our PCIs from a market here. This is the German PCI. Business activity grew at a 27-month low. New orders, employment, and business expectation gauged also softened. Input inflation pulled back to a 5-month low there. Business activity grew in Germany's service sector slowed to its weakest in over 2 years. Needlessly, input cost inflation in the service sector pulled back, no doubt. December's headline seasonally adjusted market German services PCI index came in at a 27-month low of 51.8 from 53.3 in November. By subsector, the data shows robust underlying business growth across the financial, intermediation, posts, and telecommunications, hotels, restaurants. The softer rise in employment also is consistent with a weaker business confidence regarding the outlook for activity. December saw a degree of optimism among service firms, dropped its lowest in 3 years. So Germany is not in as good a shape as one would think. Saw a decrease, this is December, in outstanding business at German service providers. The first such a fall in 10 months there. The conclusion here from Phil Smith. In Germany, where the manufacturing sector sneezes, there's a good chance that the rest of the economy will catch a cold. That's an interesting comparison. The PMI showed service sector business activity growing slower throughout Q4, down to its lowest level in 2 years, alongside the lingering uncertainty towards Brexit. And Brexit is affecting all of the Europeans. The recent sharp rise of input inflation in the service sector, which reached a survey high late June, July, and then in August was probably another factor behind the slowdown in Q4. Although the pace of job creation eased in December as capacity pressure showed signs of abating, many businesses took on additional staff across the manufacturing service alike. This is Germany. We'll get back to the emerging ones in the minute here. In Ireland, activity growth weakest since November of 2017. The rate of expansion in Ireland, new orders ticked up, but however was sharp, and input cost inflation quickened to its fastest in 4 months, driving a rise in fuel, utilities, and insurance bills. They were at 57.1. They were down from that. They were 56.3, which 56.3 is good. The service level of technology, media, and telecoms company registered the fastest rise in business activity. That's despite this, contrary to weak expansion in business activity. New order growth amongst service providers quickened in December, as panelists indicated that they had seen greater consumer interest in their services. New export business also expanded at a faster rate in December, as firms saw an uptick of international demand, especially from the UK. Kind of interesting there. And what else do we have here? Increase future in December, however, the rate of backlog accumulation weakened to its lowest in 27 months. That's backlog work. Finally, the Irish service sector providers were optimistic that business activity would increase over the coming 12 months, with around 42% of the panelists predicting a rise in business activity. The comment here, and we don't see who is commenting it, continued the trend of software growth for the past few months. Ireland's service sector expanded its weakest pace in December, in contrast to new order growth quickened. That's basically what they said before. And we'll do China now. This is the China General Service PMI. Data covers both manufacturing and service. Showed a further rise in overall Chinese business activity during December. Moreover, the rate of expansion picked up from November. That is when the composite output index rose to 51.9 from 51.9 to a 5 month of 52% there. And let me just get this up a little bit here. The improved headline index reading was supported by higher activity levels across manufacturing service sectors. Service companies registered a solid rate of growth, while manufacturing output expanded slightly after 2 months of stagnation. The upturn in service activity was shown by seasonally adjusted Chinese General Service Business Activity Index, edging up from 53.8 in November to 53.9 at the end of Q4. Despite the strong rise in output, new business increased only slightly during December, and new work from abroad followed a similar pattern, with further decline in export sales at manufacturing, contrasting with a substantial rise at service providers, notably new work from abroad across the service sector, expanded at a quicker pace for 6 months in December. On the employment front, staffing levels rose only slightly at service companies, while manufacturing continued to reduce their workforce. The pace of job creation across the service sector was marginal, having weakened to a 3-month low. Goods producers, meanwhile, registered a modest decline in employment and was similar to that seen in November. Backlog of work rose across both monitored sectors in December. Outstanding workload continues to rise at a modest pace. And the key points here: solid rise in service activity, manufacturing output returns to growth, and a soft increase in total new work. And the commentary here is amongst the gauges included in the survey. The one for new business dropped slightly in December, and a rebound of there. The employment measurement stayed in a positive territory, but edged down, further indicating that employment absorption capacity in service industry weakened mildly. The gauge for prices changed by by service providers, input costs both edged up, and the measure for business expectation rose, reflecting service providers strengthening confidence in their prospects. Overall, the composite output index picked up marginally to 52.2 in December, reflecting an easing downward pressure on China's economic growth, although the index for new export business rose for one. Overall, new orders dropped, reflecting weakness in domestic demand. The employment gauge slipped further into negative territory, implying increased challenges to stabilizing employment, which was the broader context of December's central government policies to increase jobs. Measurement for future output, which reflects business confidence, edged up marginally, although it remained downward. So that is China. And let me jump back here to the emerging markets. This is Stanbic Bank. This is a PMI for Kenya. Data was collected the 5th through 19th. Output new orders continue to rise sharply. Backlog declined the first time since July. Kenya's private sector businesses enjoyed a solid improvement in operating conditions during December. Output new orders recorded further sharp increases, with the latter growing at a faster rate than in November. Employment gains also improved, while input buying expanded sharply. At the same time, cost inflation weakened. That's what we want to always see. The headline figure rose above 50%, showing an improvement in business conditions. Staffing levels recorded a modest rise during December. Employment growth was driven by increase in casual workers, in line with the rise in new orders along this supply chain. Manufacturing strong efficiency. Purchasing activity grew substantially during December due to further expansion in new orders. However, the rate of purchases was the second weakest since 2018. Likewise, stocks of purchases rose at a slower but a market pace. On price front, Kenya's private sector reported a softening in overall price input in December. In fact, the rate was at a 5-month low of around 14%. And the rate, let's see, this is at 53.6. That was a headline. PMI rose from a November reading of 53.1. Solid achievement in the private sector. This is, of course, in Kenya. And on the average, the PMI reading was the strongest since 2014 when Barack Obama was president. New orders at Kenyan businesses continued to rise sharply, with the pace of increase slightly faster than in November. Consequently, firms raised activity levels as marked the rate, although the latest increase was the softest in 3 months. So this is all we have here. Where costs did not rise, firms point to higher transportation and food costs, as well as other sharp increases. Now to Uganda. This is from the same people here. The Stanbic Bank. Continual growth in new orders and outputs. Companies raise staffing levels. The report contains the latest analysis of data collected from the monthly business survey, sponsored by Stanbic Bank and produced by IHS Markit. Has been conducted since 2017. Companies increased their staffing levels, purchasing activity, and inventories during the month. Higher staffing levels help lead a further reduction in backlog. Overall input prices increased in December. The PMI calculators weighted the average of individual subcompanies, new orders at 30%, output at 25%, employment at 20%, suppliers delivery time at 15%. Stocks of purchase at 10%, a reading above 50, as it is in all of these, is an improvement, while the average below 50 is a deterioration. Their PMI was very good at 56.6 in December, up from 55.7 in November. The latest reading was higher than the series average of 53.2. So effectively, emerging economies are in better shape than some of the others we were looking at here. And that we wanted to look at, particularly with the actions of the U.S. Federal Reserve in the interest rates. Has it gotten there yet? It evidently had not arrived on the scene. I'm about to finish these PMIs up here. We want to go back and do Mexico, because we want to move. Here we go. Mexico's manufacturing PMI remains in a contraction amidst back-to-back declines in production here. So on December the 2nd it was released. Mexico's manufacturing industry stayed in contraction at the end of the year, with further reduction in output and buying levels. The headline market Mexico manufacturing PMI was unchanged in December from a mid-quarter reading of 49.7. As below the 50, obviously. Production decreased due to a combination of subdued demand, competitive pressure, input shortage, etc. From a mild increase in new work was registered in December. Growth was underpinned by product diversification, though curbed by unwanted stock accumulation at clients. And weak sales, soft demand leads to there. And quantities of purchases declined from the second straight month at the end of the year, but at a smaller, softer pace. On the cost side, there was a moderation in inflation to the weakness in 15 months there, largely attributed to peso depreciation relative to the U.S., with firms citing higher chemical, food, metal, plastic costs up. The trend was mixed. And from, let's see, who do we have here? Pollyanna De Luma. She's a principal economist there. Mexican manufacturing sector showed a little sign of shaking off its fatigue in December, posting back-to-back modest contractions in production. Businesses continue to struggle in face of soft demand conditions and another round of marginal rises in output pricing fail to recoup the growth momentum in new orders. Data suggests that domestic and international markets were the source of the weakness, reflecting a wider sluggish performance of the Mexican economy relative to low sales to U.S. companies responding to subdued workload by reduced headcount and employment down for the first time in over a year. Bay on a marginal basis, that is Mexico. Let me jump back here and over and see if we can get some numbers here. I think we're going to have to go to another screen here to get some. Not sure why this is here. Without having to take a station break here, we hope. We're going to have to take a station break. Well, we'll go to the BBC and we'll do the numbers from the BBC for the simple reason it's easy to do that. We did have some market watch numbers here. How worrying is that China's slowdown big at the BBC here. We just talked about it and what is going on in China. Let's go now to the market data. And we'll get these. We'll start in Asia, in Bombay. In fact, they're at 0.51%. They're up. The Hang Seng is at 2.24%. All up. Nikkei is down a negative 2.26 there. And let's skip back to Europe. In Amsterdam, they're at 2.41%. The Calc there in France at 2.72, and the DAC that is in Germany at 3.37. Stas, is at 2.95%, and in Madrid they're at 2.52%. The Dow on Friday was at 3.29%. The Nasdaq at 4.26%. And out in Chicago, they were at 3.42% there. And the commodities, well, Brent crude was up $1.98 futures at $57.06. West Texas crude was up also $1.85 at $47.96. T-Boone Picking was still jumping for joy there. Gold was up 19 cents at 1,000. Let's see where's gold went here. At $1,290.35. That's on the Forex. And we don't have anything on that. So that was commodities there. Let me just take a station break here, WBRN Radio. Okay, this is over the Market Watch here. Just looking at some things. According to this, let's see, they have gold at $1,286.20. That would be down $8.60. We got oil right. The Philly Semiconductor Index, let's see, did it rise here? At 1,143.96. It's actually up 4.37%. I thought we'd look at this earlier. We had some very interesting situations with that particular index. This is of the chips, S&P positive on Micron. That's a chip maker. And let's see, we get the Russell 2000. I guess we need to get it. The change was 3.75 for the Russell 2000. We already gave the Dow their situation, and NASDAQ, Dow Jones average, the index was up as far as change at 1.48%, and NASDAQ at 4.48. Barron's 400 index, don't give that very much, at 3.70%. The volatility index at a negative 15.99. That is the CBOE. That's the volatility index. We usually give that index changes negative point not 7 there. Let's see. The Shanghai Composite Index at 50.51, in the Hang Seng Index at 5.67. The Nikkei, the index is down a negative 52.82, or negative 2.26 change there. As we go through all of these indexes, we got FTSE already. I think we've done everybody. This is from a Market Watch, a little different situation here. We thought we would get it in, and I believe we got one other thing, a little anecdotal stuff. We've been looking at apartments and vacancies. This is out in Seattle. 1 in 10 apartments in Seattle are empty. Rents are dropping. They're giving away widescreen TVs and all sorts of things out there across King and Snohomish County. This should live in Seattle. That's some reason I can pronounce this Snohomish. The second quarter, the largest drop in decades. 2.9% drop there, and they're giving away things like a 2.5K Amazon gift card, unbelievable. And 2 months of free rent plans with $1,000 Amazon. This is in Kirkland. It's on First Hill in Seattle. That was the first one. And newly reduced price. It's in Snohomish. A month's free rent, a 2 months free rent, and parking. On the east side, rents dropped to 2.5%, or $50 in the last quarter. Rents remain virtually unchanged in South King County. Anyway, these are some of the rent drops. 3% is Belltown, that's downtown Seattle. The South Lake Union, that's over by the University of Washington. You should teach there. Anyway, Kirtland, Issaquah, etc. here. And Seattle rents are dropping at the fourth fastest pace in the country, behind Cleveland, Oakland, and Spokane. That's out in western Washington state. So that's very unusual there, that the rents are actually dropping. Rents had been going up there, but we still have a severe housing shortage there, and a high homeless rate. Average asking rents for all are now at in Seattle $1,924, and on the east side, basically about the same in Snohomish, $1,500 there, and $1,448 in South King County. And region-wide, extra, $691 in rent amounts to about $8,300 in extra costs over the course of a year. So, in other words, rents are still not running cheap. The Seattle area, which is the 15th largest in the country by population, has the fourth most multifamily approved units in 2018. Only New York, Los Angeles, and Dallas area have given out more permits. So they are building that. A total of 24,000 units are under construction, scheduled to begin soon in Seattle. What is needed in Seattle is more affordable housing in some other metro areas. Now, one thing we are looking at here at the numbers man regime is softness to continue in the economy. We're also looking at where Q1 will come in. All predictions is out there that the GMP rate will fall. definitely under around 3.2 and under 2.2. I'm sorry about that. And a little under 3 point for the year 2018. Haven't got that one in yet, but we do see those things occurring, and the long-range forecasts from various outfits, including the Fed, is for weaker growth in 2019 and 2020. So we're seeing very interesting things happen here. Weaker growth, and at the same time in manufacturing, although it's risen, the personnel of skilled workers are just not there. So if you don't have the skilled workforce, you cannot expand. That's a problem with the education system. At the same time, we have a government shutdown that's affected almost 1 million people, and there's a substantial number of contractors. People that do coding and other things are mixed up with people that clean buildings, and they are not being paid. Very important situation there. The Bureau of Economic Analysis is closed down. The IRS help desk is closed down. That helps people, that is. And the IRS in itself is basically closed down. So there are a number of government functions there. If this continues, people will not get assistance for their 2018 returns, nor will they get their refunds. That starts at the end of January. Even such things as food subsistence, a stamp, or food stamps, what do you want to call it? That's Department of Agriculture. They are also on a furlough. The national parks, the garbage is stacking up. In fact, it's stacking up across the street in the White House. And in Washington, you'll be getting even to warmer temperatures. So what does that mean? The Statue of Liberty is open only because of the state of New York. Grand Canyon is open because of the state of Arizona. But you have these national parks, and many of these national parks, people visit them in great numbers, even in the winter season. So those are some of the things. In other words, I guess we have a lot of headwinds spinning around now that have not spinned in for the final one, as one would say. But all of the conditions are here. The PCIs we just explored, with the exception of Kenya and Uganda, some of the emerging markets. China is a little bit better off than they were, but employment has to adjust. I think we said early in the year, last year, 2018, that China would lose roughly about 0.5 of their GDP. They're down, 6.5? We'll get the latest numbers in here. I was going to get those, but we'll have it on the next broadcast. Nonetheless, that would do it for us. For those in business, make next week a productive one. The consumer, you kept your eye on the prize in December. We haven't got the final retail sales in, but don't be surprised. They're going to be higher. This is sort of like what had happened in Q4 as far as job creation, but that is an anomaly. Be very, very careful when you have higher numbers that are out of the average, say 250,000, 200,000 jobs created. During President Barack Obama's term, you averaged about 200,000 jobs, the average per month since the Depression. So in other words, pretty much you look to some normalcy now. Obviously, you're going to have a month that's an outliner, but basically speaking, you'll have that. But when you blow up, or you have the market that goes up, market goes down, those are things we look at for there, because they normally signs, especially that volatility index, of things not too pleasant to come. And we see a lot of the outer weaknesses coming here, and the tax cut, the beginning of last year, that is played out. People are now trying to get the refunds to pay their bills.